Good afternoon, boys. Today we're going to be looking at non-compulsory insurance, and we're also going to be studying certain concepts that you will need to be able to explain and elaborate on. So when we talk about non-compulsory insurance, what do we actually mean? So non-compulsory insurance means that it is voluntary. The insured has a choice as to whether or not to take out that contract. So I can choose not to insure my vehicle, not to insure my wedding ring. So it's totally voluntary. In other words, there is no law that says you must take out this type of insurance. What non-compulsory insurance does is it transfers the risk of something happening to an insurance company, right? So the risk of my house being burgled, I'm transferring that risk to the insurance company. Non-compulsory insurance can also be short-term or long-term. So short-term insurance would be household content, vehicle insurance. However, long-term insurance would be things like a life policy. The next thing we need to look at is different insurance concepts. And once again, you'll need to be able to explain and elaborate on these. So the first concept is what we call overinsurance. And as the term says, overinsurance, one can assume that you have overpaid for something. So let's say I have a wedding ring that's valued at 10,000 Rand, right? But I think it's worth 20,000 Rand. So I overinsure it to the value of 20,000 Rand. The problem is, if my wedding ring is stolen, I will not be paid 20,000 Rand for it because I have overinsured it. So overinsurance is when the item is insured for more than the actual market value. Businesses or individuals will not receive a payout larger than the real value of that item. This means that the extra money that I paid in my premiums will not be paid back to me as the insured. So the next concept is underinsurance. So let's take the example of the wedding ring again. I don't have a lot of money to pay high premiums. So I say that my wedding ring is now only valued at 5,000 Rand, when in fact the market value is 10,000 Rand. So the premium that I have to pay every month is a lot less. However, this occurs now when a property or an asset are insured for their full market value. The property or asset is insured for less than the current or actual value of the property. So what do I actually mean by this? So should something happen to my ring, I'm not going to be paid the full market value. I will only be paid up to the value that I insured it at, which is the 5,000 Rand. And this is where we use what we call the average clause. And the average clause helps us calculate this amount. Right, so what does average clause mean? It's a stipulation set by the insurer, right, which is the insurance company, which is applicable when property or goods or assets are underinsured. So in other words, they're insured for less than the actual market value. The insurer will pay for the insured loss or damages, but only in proportion to the insured value. So that ring of mine that I valued at 5,000 Rand when it was actually worth 10,000 Rand, they will not pay me more than that 5,000 Rand. This means that the insured is responsible for a part of the risk that is not insured. So I have only insured my ring for half of its actual value. Right, the final concept we are going to be looking at is reinstatement. And this is a stipulation whereby the insurer may now replace the lost or damaged property and goods instead of being reimbursed, instead of getting the cash back. This stipulation is applicable when the property or goods are overinsured. Okay, so for underinsurance we use the average clause. For overinsurance we use reinstatement. The reinstatement value will not be higher than the market value of the loss. The insured is restored to almost the same financial position as before the loss occurred. So here's an example of how reinstatement would work. A business property has been insured for 300,000. but the market value for the property is 200,000, right? So I have overinsured. If it is destroyed by a fire or a storm, the insurer will rebuild the property instead of paying out the cash. And that is what reinstatement means. Now please note that there is no calculation for reinstatement, only for underinsurance, which falls under the average clause. So the last thing we want to look at in today's lesson is what is the difference between over and underinsurance. And if we look at the slide, please note that everything on the left-hand side is overinsurance and everything on the right is underinsurance. So the first thing for overinsurance is that the property or the assets that was insured for more than the actual value that it's worth. Whereas with underinsurance, the property that is insured is for less than the market value. Right, for overinsurance, you can choose to reinstate the insured. However, for underinsurance, the insurer will implement the average clause to determine the amount that will then be paid out. So the average clause is a calculation, but for overinsurance, you reinstate. For overinsurance as well, businesses will not receive a payout larger than the actual value of a loss, which is the market value. However, for underinsurance, businesses will only be paid out for the amount of the goods or assets that